Alrighty, guys. This week we're going to go ahead and look at sales and cash receipts. One of the things that we're going to be doing, not just learning about the sales and tax receipts, it's also that we're going to be learning about the how to record them, and then we're going to be learning also about how to journalize sales, the tax, returns, allowances, discounts, all of that. Okay. So if you ever wondered what happens when you go to Walmart and you do the bleep 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 and if something's on sale or you give them a coupon, that automatically gets done and is added into their software because of the fact that it's been set up to journalize all of the discounts that they're doing, not only for the customers but also their vendors as well. So here we go. All right. So from the seller's point of view, it's like Walmart's point of view. Okay. The retailer is a business that buys items from manufacturers um, and wholesalers. So, for example, Walmart doesn't make anything. It buys stuff from other people, and then, well, it has stuff made for them sometimes because it does have their name brand on it. But it's also a retailer because it retails other types of products that have their own marks on them. Like they don't generate videos, but they're selling the videos. They don't generate the CDs, but they sell the CDs. Um, they don't generate things like the Logitech cameras or the iPhones, but they resell those. So it's a retailer. Uh, one of the things that they do that is they buy, right? Now, the other thing is that the gross sales or the amount of money that is captured is rung up on cash and is recorded in the register. Okay. And that's what we're talking about. That is the fact that all of the stuff is coming in. Now remember, you have stuff that we buy as a retailer that Walmart buys cash or that it's going to pay in the future for payable, or the stuff that they're going to allow somebody else to pay them later on. For example, your Walmart card, right? You can either use it right there and then, or if you decide to pay later on, it's something that you owe to Walmart. Walmart sees it as an accounts receivable. I'm going to receive this money sometime in the near future, but it's still based off of the revenues for, let's say, this month of last days in February. So, for example, again, if they were to buy, let's say, um, and they received so much in cash and then so much in accounts receivable, then their sales would be the $3,000. It's still credited to sales. Okay. So then from the seller's view, okay, here we have the amount of money that we made, the revenue that we made or the sales for cash. This is how we record it. The amount of money that we're still going to be paid in the future, but it's off of this, let's say, sales of July, the way it's recorded here. So we go ahead and put in that sales is the $3,000. Okay. Now we get into okay, things such as a credit. Okay, and don't let that confuse you with the normal balance of an account. This is a sale return, either because of a price reduction or a new product or a refund. Okay, it's a contra revenue. So let's say that my aunt, who is the queen of returning things, let's say that she bought something for $10. Okay, so what you're going to, and it was on her account. So let's say that she decided she bought something for $10, and notice where you debit the amount that was returned and you then credit the accounts receivable for $10, which means that this accounts receivable right here is going to be reduced by $10. The reason that you put the person is because it's them that that was owing you the money. So you have to individualize it to whoever owed you the money. You're going to give them back their money. But overall, you're still going to reduce the accounts receivable overall by $10. Now notice what it says, issued a credit memorandum. So you show that you gave them that credit. So this is what ends up happening, okay? So let's say that you have on a sales discount. Cash debited for the $39.20. Sales discount Okay, here you're giving somebody a discount now. You're not returning something, you're giving them a discount. The entire sale or the amount that you're selling is $40. But cash you're getting in $20, sales discount 80 cents. It's a contra revenue. What you're doing is you're now recording how much money you gave as a sales discount that you didn't get from cash. Let's say that I gave you a coupon and you're selling to me. And I gave you a coupon and say this is 80 cents taken off of this item. So that sales coupon then is a sales discount that you give. Now, those coupons then are then all picked up, put together, categorized. They send it to the person or the manufacturer that is giving the coupons. Let's say that I bought something for Country Crock. No, it's $39. So let's say that I bought what would I buy for $40? Let's say that I bought a small portable hard drive. Okay, but Logitech was giving me not a lot of money back, but at least a little bit, right? So I get those 80 cents back. I give them the discount, the coupon. They debit the sales discount, and then they only credit me, or they only put in the accounts receivable for $40. See? Now the reason is because they're still going to get that money in. I've given them cash, and then the 80 cents they're going to get from the company because of the coupon. Okay? But they still have to show it all together. The discount is, of course, when the discount is granted as well. All right? So that another way of doing a discount is a huge amount. Okay, let's say that, and this is what we're going to be doing now, is helping you understand that. Let's say that a company buys from me, and let's say that they're buying, I don't know, printing equipment. This right here, this numbers here, says that a 2% discount will be taken off the bill if it's paid in 10 days. Okay? The full amount, regardless though, whatever the amount is still the amount that is due in 30 days. Okay? They still have to pay me within 30 days. If there's no discount, if I'm saying N of 10, that means that there's no discount, but now this person is going to pay me in 10 days. I still make the sale, I still record everything, but the credit period is given the length of time allowed to pay on the entire bill. Okay? So, this is what it looks like here. Cash, $39.20. Sales discount here. Accounts receivable, again, payment from the sale on account, $40. That's there. Now, sales tax. This is what all the stuff that happens when you make a sale. And that money goes to the comptroller's office. So, for example, everything that is sold here in the state of Texas, we have sales tax on it, right? We go ahead and ours is 0.825, 825. So that means that everything that is sold, we go ahead and we pay so much tax. That money that's picked up for sales tax is then all that money is sent in, put together, and is sent into the state comptroller's office. The business has to send in. It's a liability to the retailer. So if the sales tax was 0.5, then it would equal $90 on the sale of this item. So it's 1,800 plus the $90 gives you then the total amount that the buyer has to pay. Okay, but those $90 don't stay with the person that's selling you the item. That goes to the state. So here's how the sales tax and the charge of the sale is computed. Okay, why they don't stick with the 1,800, I don't know. So let's now say that something was sold for 1,200 times the 0.5, $60 worth of tax. So the total sale is 1,260, and it's going to be on accounts receivable. So, okay, we're now showing both. This was sold for cash. This was on accounts receivable. So this is credited. This sale is credited to cash. Debited to cash. This is debited to accounts receivable. The sales tax, though, is taken to payable. This is the 60 plus the $90 together for that day. So it's $150 that we put into sales tax payable. Because remember, again, we're going to pay that at the end of the quarter to the comptroller. So the total sales is the $3,000 that we have here. Okay. Now, how are you getting that? Well, hold on a second. Let's compute. The way you compute that is this. The 90 is the sales tax. The 60 is a sales tax. So my sale was only $1,800 and my other sale was only $1,200. So that's how you get the $3,000 of sales revenue coming in. The 150, the 90, and the 60 is not considered as a sale. It's sales tax and it's given to somebody else. So that's how you compute how much your sales were. Okay. So this is where you see it with your T accounts. Okay. Cash, 1890. Accounts receivable, 1620. Sales tax liability, here you see the 90 and the 60. And then your sales of revenue is just your 3,000. Okay. So then the transactions on account for Arts Company. Arts Clothing Company is a wholesaler, buys merchandise from other people who in turn sell it to individual customers. So as a wholesaler, for example, that means that Art is now the one making things. He's the one making the clothing, shorts, t-shirts, shirts, whatever the case may be. Okay. So this is what some of the things that happened. So here we go. He sold on account merchandise to Bevan's company. That means Art sold this to Bevan for 1,600. Invoice number 2 for 2% discount if paid on 10 days. If not, then he owes the entire $1,600. Okay, so let's see. How much then does that mean that he's going to have? So what we're going to see here then is we're going to see some of these things that are going on, but we're going to see the sales invoice first. Okay, so you see this. This is a sales invoice. This is number 1. This is House Clothing. Okay, it's sold to House Clothing, right, from Arts Wholesaler. Here we go, right here. Date is April the 3rd. Purchase order number 430. Shipped via the Acme Truck Company. And these are the terms. 2% in 10 for and if not, then he has to pay the entire bill by 30 days. So he has a quantity 20 of men's dress shirt, okay, for $20 a piece. That's $400. 10 lady designers jeans, okay, $15 a piece for $150. 50 baseball caps for $5 each makes that now $250. So his total invoice right now that he owes is $800. Okay, that's a sales invoice that House Clothing owes. So here we see the $800 going up, right? Total clothing, $800 of the asset is going to revenue. So this is what we see. Now it's an accounts receivable because he hasn't paid yet. Okay, so it's accounts receivable to House Clothing. The sales is a total of $800. Now, this is a subsidiary ledger. It's a special ledger that we're going to be getting into. So let's go back again. Okay, $800 that he made. This is how we record it. Okay, now we go to part two.